Hi again. We're now going to the next panel discussion. The topic is rethinking Zimbabwe risk. What are we pricing? And the moderator for this panel is Ray Chipendo. Ray, over to you.
Yep. Thank you very much, Patrick. Welcome back. They often say this is a graveyard shift, but I'm so encouraged to see lively faces. Everyone is feeling so energetic. So we should be up for a cracking panel. I'm privileged here to have a very talented lot from the extreme left. I think I introduced Candice. And next to her is David Ziambi from London. Next to him is Ken. We had a panel in the morning. And last, Nkosana. I'm going to try to do this at lightning speed because we're running out of time, but I will not deny you the chance to ask any questions if you have. So at the 20th minute mark, you can just interject if you have any question to make this more interactive. I think this will be a very interesting panel also for the government of Zimbabwe. This is stressing on rethinking Zimbabwe risk. What are we pricing? And we're keen to hear the views of this assorted speaker cast, internationals, regional guys, and those that are working in Zimbabwe. So to start, let me just start with David and just pose this question and say, when investors are looking at Zimbabwe, what are they defining as risk?
So I think it's a loaded question, actually. There's a lot of different aspects that quantify risk for an investor, and also it depends on what kind of investment you're looking at. But the principal ones are political risk, currency risk, and I guess execution risk. These are the ones that come up principally. Obviously, there are a lot more, but those are really the ones that come up most. And really what you end up in a position is trying to structure around those risks and see how you can get people comfortable that those risks, although they may exist, and I say may because in some cases they don't, are not actually going to impact on their investment in a way that will extract value.
Sure.
And that's really the aim of the game. When you look at this, particularly institutional investors and specifically people in fixed income, debt products, etc., they are looking to minimize risk because their returns aren't as large as an equity investor, classically.
Sure.
So minimizing that risk allows them to feel more secure about what they're putting their money into. So the types of risks that you're looking at are actually quite big, and they're systemic risks that sometimes are difficult to control, which is why structures become so important. So looking at risk in Zimbabwe, I would say those three items, but they can all be managed through structuring.
Could you attach any figures on a scale of 1 to 10 across those three categories?
Well, I would say actually currency risk now is the biggest one because of liquidity issues, because we don't print our own currency, etc. So I mean, in terms of 1 to 10, I'd actually put it up at a 9.
Right.
And it actually goes back to something that Ken said earlier. You know, you can put money in, but how do you take it out? And if you're booking entries, in your accounts and you're saying, well, we're doing really well, this is how much EBITDA we're getting, etc.
Yeah.
But actual physical currency that you're able to take out and repay your investors, you're not able to get out of the country.
Yeah.
That's a no-go for a business. They will not invest.
Yeah.
So I would say 9 or 10 for the currency
9,
risk.
10.
Political risk is something that exists everywhere. Zimbabwe is not unique. So that's something that is one, partly education, and two, part structuring. I would say the cash issue is fundamental and systemic.
And when they refer to political risk, is that policy? What exactly are they talking about? Is it risk of a meltdown in the political system?
I don't think it's really a meltdown. I think a lot of it is about stability. So every time that you go into a country, any country in the world, you have to have a dialogue with a government or some kind of governmental entity, be it for licenses or whatever it is. What you really are after as an investor is stability and looking at if you actually, you know the rules of the game.
Sure.
If the rules change frequently, then stability becomes a problem and investing becomes a problem.
Sure.
Because if you're consistently having to change how you actually get money out or how you actually realize an income, then it becomes untenable.
Yeah.
And other places with less of those kind of risks become more attractive.
Yeah.
So I mean, there was the issue in the diamond sector recently where the Chinese entities had their licenses extinguished,
Revoked,
etc. And I mean, it was valid in terms of what was done, but the effect of it didn't actually go down very well, because in terms of risk and looking at the security of an investment, the outcome wasn't something that the international community looked at and said, that inspires me with confidence.
Sure.
So I think a lot of it is actually just stability, understanding that you've got certainty. If I were to go to courts, this is the outcome for this particular problem, and I'm certain about that. And it allows an investor to be able to look at a situation, make a calculated decision about whether they want to expend capital in that jurisdiction.
Interesting. Candice, you almost have that broad view as well. You're interacting with a lot of fund managers who are looking at Africa. Could you perhaps just overlay the case of Zimbabwe next to that of Africa? What are people saying are the risks in investing in Zim vis-a-vis Africa?
I think there's also another risk, which is the credit risk side. I was fortunate enough to speak on a panel to pension funds, the pension fund community at WEF in Durban, and looked at it from the perspective of how somebody like Teresa Whitmarsh from the Washington State Pension Fund looks at this. So it's pretty difficult when you don't have sovereign ratings.
Yeah.
Because you don't really have a basis with which to even start pricing in credit risk.
Sure.
So we play an interesting role, I think, as a financial technology provider in trying to find additional ways for people to be able to manage how you measure risk. So I find credit risk one of the most fascinating places because there's so many elements to that. But if you look at the stock exchange, it becomes a very interesting way of looking at listed companies who actually are economically obliged by the stock exchange rules to provide their financial statements.
Yeah.
And there's some very interesting proxies in that data that allow you to start to imply ratings across sectors and across industries. And we do that through a product called Starmine, and there are very specific models built into that that allow you to start to price in that type of risk. So I find I'm looking at that more than in most instances across Africa.
Yep.
We do a lot in the risk space as well. We've got a country risk metric tool that looks at something like over 250 sources of data. They come from, you name it, across the board, the World Bank, the IMF, and local sources, and really that's broken into political, economic, and criminal risk factors.
Sure.
47 dimensions are looked in that model. So quite frankly, you can almost graphic equalize your weighting and say, in fact, R&D is a really interesting metric if you want to see what we talked about on the earlier panel, things like investment in IP, investment in technology. You alluded to it, education, really high up in terms of skills, transfer of knowledge. Those things rate really highly. So back to Teresa Whitmarsh and the Washington Pension Fund. They don't look at things in the context of macroeconomic risk. They're going into examples that the Honourable Ambassador talked about. They are going into finance infrastructure deals where they know to the granular degree the state, the people, the human interaction, the trust, who the partners are, and they actually analyze risk on that basis.
And how is Zim faring on that kind of scale?
So hard to say because I think it's all so personally motivated. It depends on what sector and what your drivers are. You talked about it, Ken, earlier. It's very different if you've got the right partner on the other side who can help you actually, because it's a mutual synergistic relationship for the in and the out capital management piece.
Yeah, okay. Ken, where are you seeing a disconnect between risk perception and actual risk, where you feel people have a misperception, they have a wrong perception of what risks are there in Zim?
You must have been reading my mind. So I was thinking exactly about that. Unfortunately, people's perceptions are the reality. But those perceptions are not always the reality.
Yeah.
In fact, in most cases, they're not. And the press has a role to play in this. And unfortunately for the Zimbabwean case, it's been a very negative portrayed image for a long time. There's been a lot of propensity of sensationalism about Zimbabwe, and that's created a perception of risk that's much higher than the reality. I was speaking to the good doctor who recently was in Harare, and he told me he was pleasantly surprised that what he found there was certainly not what was his expectation. And I have not yet come across one investor, and I've brought dozens of investors to Zimbabwe. I haven't seen one who's after 1 hour in Harare hasn't said to me, what's the big deal about? I don't see a war zone. I don't see hungry people. What's going on?
Yeah.
So the issue is really just this negative brand that we've created for ourselves about Zimbabwe. And when it comes to risk, I agree that things have to be certain. It needs stability. But I also think it's about mitigating that risk. And the only way to really mitigate the risk, in my view, is to get into the market. To get on a plane, go into the country, have a look at what you're doing, meet the people you're dealing with, and get local knowledge. Get partners who understand the local risk, who can manage it. Because 99% of the risk is commercial. Although we talk about political risk, unless you're doing a huge macro government deal that involves a G2G kind of signing arrangement, which probably doesn't involve much of the private sector anyway, your political risk isn't really there. The chance of Zimbabwe becoming a war zone is very little. No matter what happens with the political leadership at the next elections next year or for the next 5 years, it doesn't really matter. I believe the risk is not so much a political one. It's a lot of hype about it. In reality, the risks are different. I agree with my fellow panelists that on my left that the real risk at the moment is the currency risk, the liquidity challenges that you have. And that's why I said, and I genuinely mean it, that any investor coming in needs to come in with their eyes wide open and partner with some kind of entity like Kosana's business or any exporter where they can mitigate the risk of getting their money out.
Yeah.
And if you can solve that risk, then there really isn't one.
Interesting. So, now, Kosana, you are involved in this mining commodities. It's probably one of the most volatile in terms of prices, mineral prices, and also you're not investing in assets per se, but this are mostly reserves where there's so much variability. It's probability of, say, we are making a probability that there is so much content in the ground. How are you pricing risk? Because you also mentioned that most of your capital comes from the US.
Yes.
Yeah.
Yeah, the way we look at it in our area is that, like my other panelists have said, there's a lot of weight that's being given to the political risk that's not there. So you tend to see that over the years, what that has done, a lot of assets that are in Zimbabwe have been undercapitalized because a lot of people were scared to put in the money that those projects require.
Yeah.
Now, because of that, you find that in general, in terms, the assets have been undervalued, especially heavily undervalued in the mining sector.
Sure.
So the way we looked at it in our end, to say how do we then mitigate it and say, okay, you are getting a lot of assets that you are really getting them at fire sale prices.
Sure.
And then if you have a strategy that can turn around and make those assets, you utilize those assets and, earn on those assets, the return that you are getting, you are even being paid for that heavily weighting that's put on the risk, that's perceived risk, that you actually are not going to suffer. So you're being compensated for the risk that you're taking that's not there. Yes, liquidity risk of late is now been, as I talk to most of my investors, is what's getting a lot of people. They're saying, wait a minute, what's going on with this? Africa is Zimbabwe's bond currency, as we say, is the strongest currency in Africa, but why are your neighbors not taking it? That's the question that I'm being asked. But again, that gives another perception that's not there, that, okay, the fact that the neighbors are not wanting it, which means no one wants it, therefore I'll be trapped if I go in there. Now it's up to companies like ours, capital, to explain that risk, that, how then do we mitigate that? Then you find ways of partnering with other exporters and see how you can get money out. Because everybody else is worried about how do I get my money out, and it's tending to scale a lot of people. But there's a proper way, there's a government lay down, if you apply for dividends return to the tune of your investment in, they're allowing you to take out. But now a lot of people are just not willing and taking the time to explore that area.
Another area that people have raised concern about, particularly in the mining sector, is to do with property rights and the ownership of claims. Is it the government that owns mine claims, or is it individuals, or is it the community?
Actually, Zimbabwe is one of the best mining laws there is around, and I'm not just tweeting that because I'm from Zimbabwe. In the sense that in Zimbabwe, mining rights override other rights. In other words, if I find gold in your yard, literally, if I have the right to mine it, you have to give me access to it. You know, to bring back the old attaché when Lobengula was talking about gold, now taking back to history, he asked the question that, wait a minute, Rhodes, if you find gold under my feet, will you dig? And said, yes, I will. So those rights have carried on actually up to this day. So you find that, you know, in terms of mining rights, a lot of people that are not getting mining, I'm noticing that really don't understand that. But mining is given preference in terms of as far as land rights. So when somebody has a claim and they're keeping it up to date, they have the right, and they will, and that's why you see in a lot of cases where there are disputes, you find that the government steps in and said, let's put a hold, because they really want to make sure the two parties are satisfied. Whenever there's a mining claim dispute, the government puts a hold, they say, guys, step aside, and priority, they go in and try to resolve that issue as quickly as possible. Okay. So in mining, when you have your claim in your name, you do have that right. You can exploit that resource, and really, most people perceive that, okay, owning a claim, how much is that? It's less than $500. It's the only country where you can get a bulk of claim for less than $500, and the government is willing to put their neck behind it and say, if it's your claim, you're working it, we'll let you do it, and we will even prioritize your case in court and let you that any overlapping claim issues be resolved.
Sure.
So you have that.
Okay.
You know.
Interesting. I think last year we had our first conference, we had a panel on commodities exchange, and it had to do with the issues that you've got junior miners that they have verifiable reserves. All that they need is capital to mine that mineral and take it out. Can't we have individual parties like private companies saying, look, I'm going to advance payment, and then I will make sure that when you sell your product, I will get my money back. Or even way down the stream where you have got someone who has got a whole lot of chrome there, it's probably going to be sold in the next 5 days, but payment is in 60 days. Can't we have individual companies, and some of you have got those kind of skills where you could actually say, I'm going to take a bet on the price of chrome. So I'll buy it at a discount, and I'll give you an advance payment sort of as a future. How far do you see ourselves from that, where the financial markets are integrated with junior miners?
Yeah, that has been a concern of the authorities also in looking at it. We find that there's a lot of projects that are under finance, and especially in the small scale to artisanal mining side. Now, the way institutions like ours have learned to leverage that, you know, most of Zimbabwe, like I said earlier on, is underexplored. And then to do an exploration program for a claim, it costs a lot of money. It costs in the upwards of, I think the current going rate, if you're doing a drilling exercise, you're paying something like $60 a meter. And in order to do an intense drilling exercise to know what you have underground, you need at least 100 meters per hole, and then you need to cover so many. So the way then we thought about it, we say, okay, there are these artisanal miners, these guys that are using their sweat and effort to find the resource. So we said, okay, if we partner with these guys, say, okay, you go out there, hunt out what you get, we will process it for you, and then we'll pay it for you. Now these guys are feeding us data that we're not paying for in the sense that...
But if it's artisanal miners, is that reliable data that they give you in terms of the content and reserve?
Well, I would say a guy who's using his sweat to eat will not sweat where he won't eat. So as they are digging, if there's nothing, he will quit tomorrow. But if he's there, because mind you, us as a big institution, we have the facilities. Whatever they dig, we analyze, we process. We analyze the process. So if he digs somewhere and he knows there's nothing, he's not going to go back there. Then I know I take out that area. And most of my areas, what I did this in comparison. I took a company from the University of Colorado that has, they use satellite imaging and all that, and then process and tell you where your resources is most likely to be and give you all the percentages of probabilities. And then I looked at an area that was being worked by the artisanal miners. You'll be surprised how when I laid it over, every place that they marked, I had already found out from those guys, And those guys, I actually paid them the gold, the free gold that I got. So I got the 50% of the gold, because free gold really is, you can only extract 3% of it, and then the rest goes into cents. Then I process the rest further. So imagine now, you're getting this much knowledge from it. The guy in Colorado charged me $5,000 just to come to just the trip, and then the whole time he was there on the ground, he was charging me $4,000 a day. Yet those guys, for literally pennies on a dollar, they were able to give me that data. So now it's again learning how do you work this unattainable situation. Now, I'm not saying it's going to work in all minerals. You can't do that in lithium because you're not going to pay more over the counter price. But things like gold and other minerals, those guys can do. They are actually the best geologists we have because they're using sweat geology in a sense, So that's another way that an institution can look at it and say, thank you. That's another way an institution can look at that and say, okay, yes, if I do an intense program, it's going to cost me that. So most institutions, what I see, they then rate that, give it a certain price factor, say, well, exploration program with this is cost this much, therefore the investment, I require such a return to undertake this investment. But then they don't look at the non-traditional ways of saying, okay, how then can I realize this investment, be able to reap the rewards of it without really going the traditional way. And Zimbabwe is one of those areas where you require to sort of think outside the box at times in order to really get the maximum returns out of it.
Interesting. I think you run the risk of sounding like a cold-blooded capitalist now. But we were talking, David, and it seems like you suggest that most of the risks that we are facing can actually we can actually de-risk them by acting in particular ways and having certain relationships. Why don't you talk to us about what are sort of the doable things that we can begin to work on to de-risk what can be perceived as risk in Zimbabwe?
Right, I mean, I guess one example is what Nkosana was saying. So if you have an export-based business and you might be aggregating from a whole lot of artisanal miners, they're coming to one entity like Nkosana's, for example, who has a relationship with people who will buy his product outside of the country. Effectively, what you're saying is as long as Nkosana's business runs and he continues to get receipts and he continues to deliver outside of the country, then really for an investor, a debt investor, I'm a finance lawyer, so I'm a bit biased, they will actually be looking at the strength of the off-taker and the credit risk on the off-taker of his ability to buy so that Nkosana can be put into funds and pay his debt. Right? So it's actually, in a lot of ways, especially for export businesses, it's about looking at each phase of risk. So you're looking at the risk of actually producing, which people like Nkosana will be used to because they're in country and they know the risks and they're able to manage them. And then you're actually looking at the payment risks, right? Because the payment risks are pretty much fundamental. That's where the money comes from. And to get around what's perceived as country risk, the payments are usually made outside of the country. All the payments are made there, and anything that's netted off, the residue will come back to Nkosana in country. And that's usually how you structure these sort of deals, because what people want to see is payments being made regularly by a credit-worthy individual, usually in a jurisdiction that's no mess, no fuss. And if you can do that, then all of a sudden, his business continues to operate the same way as it's operating in Zimbabwe, helping artisanal miners, continuing to grow, but based on debt that's actually coming from abroad, and based on payment that's coming from abroad, right? So that, unfortunately, is the way that we're going to have to progress now, as far as I'm concerned, until the market gets more confidence in Zimbabwe executing, and until we solve our currency issue. Because once that's solved, then actually you can start saying, well, forget about this offshore stuff. We're a solid economy. you can have confidence in us because of XYZ fundamentals, and because of that, we think that we can just begin to borrow and repay in a normal fashion. But I mean, until we get there, it's a lot of structuring that's involved. And this is not a Zimbabwean problem. This is throughout the continent. Nigeria, the big brother, so it has exactly the same issues. People, we recently tended on it was a $700 million drilling program for oil. And I mean, very, very solid IOCs were involved in it, and in partnership with the Nigerian oil company, national oil company, the NNPC. And obviously, initially, because they didn't think there was going to be Nigerian risk, we had structured around that. It was flooded with people who actually wanted to participate. The moment that the Nigerian government said, actually, no, we want to do it as an onshore deal. We want the money to come from Nigeria to be paid out of Nigeria. The number of investors literally
dried
halved
up
overnight because they weren't willing to take that risk. And this is based on solid sponsors, people who are willing to go and do the project efficiently, who have a worldwide a reputation. But really, it's about that perception. And it takes a long time to get the confidence in the system where people are comfortable to lend in country.
Yeah, interesting. I was talking to, I think, Ms. Kumalo over the break that one of the things that we're trying to do with this platform is to extend it into a capital markets think tank to coordinate the concerns and the opinions and the ideas, mostly of people in the capital markets, and to pressure government into doing certain things that we think can advance the economy. Because one thing that we all think when we're sitting here is if you shoot your idea into Zim, into the Minister of Finance or Reserve Bank, they are gatekeepers there. So at some point, we really need to have a coordinated approach of a think tank of some sort where people can actually coordinate papers based on good reasoning and say, look, we need to deregularize this 1, 2, 3 for us to advance capital markets. I hope the ambassador will write a reference letter to that effect. But while I'm on that, I just wanted to switch to Candice and say, talk to us about what Thomson Reuters is doing in terms of helping institutions, mostly from the West and from developed markets, to manage risk and to deal with risk in Africa. Not specifically for Zim, but it could be just for Africa in general.
So I was going to reference that through the work that we do with a lot of the stock exchanges, actually. And I would reference Mauritius as being an interesting example at the moment. So a lot of the lessons that are being, and that you've alluded to, David, from the currency components and being able to work on how you manage the currency risk components is actually being taken off the table. So you can raise an issue in whatever currency you like. So whatever currency you're comfortable with is really the mechanism that they are allowing to take place. So the Johannesburg Stock Exchange has had some interesting components built into their currency derivatives market that allow you to be able to manage currency exposure and hedge. So I see myself and the role that we play from a Thomson Reuters perspective is really just facilitating how those products come to market. We are known as one of the world's largest currency trading platforms, and pretty much every central bank in the world uses Thomson Reuters, and the commercial banks associated with that use our platforms. The fact of the matter is the currency rates, the fixings, all of the components derived from those metrics help enable all of these capital markets. So carrying that content, making it available, to your question earlier, it is available, it's just through what platforms. And that's how we're doing. I'm seeing incredibly creative ways to solve for the things that are actually blocking capital.
Yeah, it's interesting. I mean, we met with Thomson Reuters people in 2015 when we did a fixed income conference in Harare. At that time, I think the fixed income market in Zim, in terms of issuances, was probably less than $1 billion. But within 2 years, I think it has more than quadrupled. I think now we're looking at plus $4 billion in terms of bonds that have been issued. And I think that's a huge opportunity there.
And it's the scale with that, Ray. So the critical part to that is implementing processes that allow you to scale. So technology, if you're dealing with, Kenya is a good example when debt is issued, there's a courier service, literally somebody who has to take the paperwork to the central bank, and you've got a process involved in actually going through what an auction process is to actually get it to market.
Sure.
There are ways to speed those up, there are ways to open them up to more individuals.
Yeah.
And again, a market that was pretty rudimentary in the way that it was doing things is now the market in the world that's a global example of going online with Emakiba and actually creating the first technology platform for retail bond acquisitions to the man on the street. That's incredible.
Yeah. I mean, it's almost like retailing fixed income market. Yeah. So I know, Ken, you deal with risk in a different way. You're not going to be sitting in models running standard deviations and all of that, Sharpe ratios. You are dealing with it from a practical point of view. How are you dealing with, opposition? I mean, not opposition parties, but in your business, you mentioned competition, dirty tricks. What are the practical advice and what practical actions do you do? How do you deal with such kind of risks? Political interference, pressures, and the like, and fraud, in simple terms.
I'm actually quite risk adverse. Surprisingly. So
relative to
maybe the perception. But in reality, when you do any kind of transaction that's above a certain number, it depends, it's all relative, I guess, to the individual or the company. But for me, anything above $1 million figure would be substantial enough to make sure that your due diligence is done properly on any transaction. And we're very careful in doing the pre-documentation. So we get full legal opinions and advice on any transaction we do upfront. And we cover the legal and the accounting side of it. So before we even choose a jurisdiction, we want to see all the DTAs, the BPER agreements. And when we go into the structuring of the transaction, we get quite a lot of substantial legal advice, normally from several sources, so we can test them. And once we're confident that they will stand up to the scrutiny of time, because our real issue is time. We're a long-term investor, and in 10 years' time or 20 years' time, we don't want to look back at a transaction and have to face a problem that could have been avoided if it was dealt with upfront. So we tend to do a lot of homework on the upfront side and structure things properly. And I guess we've done that for the last 10 years very well. So when it comes to a potential legal issue, and it could be one that's raised from a competitor, as you've said, or a government agency. We were faced with EMA challenges in Zimbabwe with our EIS, and environmental impact assessment, which is a new thing in Zimbabwean legislation. Thanks to a Canadian gentleman, recently was changed, and we have a lot of environmental issues now that weren't there before, across a lot of sectors and industries that I think are cumbersome and unnecessary, but have to be dealt with. And we had to go into a legal process, and it took 2 or 3 years in court. I can honestly say, and we've had several other legal cases where we've sued government, we've sued the city of Harare, and quite frankly, if it wasn't for our legal due diligence, we probably would have lost. But we've won most of our cases. And I can say this, that as far as the risk of the rule of law goes in Zimbabwe, really there is none. I haven't had any political experience because I'm not a politician, so I can't vouch for what happens politically. But certainly from a commercial, private sector standpoint, and it was tough at the time. You sue the minister of local government. The one particular issue we had the president's name on title deeds. So we were standing up against some big shocks, and the fear of the rule of law is there. Is there going to be justice on this case? Are we going to get a fair and transparent hearing? Is there going to be political interference, and are we going to get a judgment that's against us because of the political influences that are there? And I can honestly say in every case that we've had, we've not found that at all. We've had very good judges who have ruled fairly and honestly, and we feel that justice prevails, that the rule of law is working in Zimbabwe, despite the perception.
I often think that, we have a recent case of Kwesa TV, and rather than seeing that as a discouraging example, I think that should be an encouraging example where if people feel that the process has not been followed duly, that they can go to the courts and have that dealt with. And I think that's an encouraging thing because it means people have confidence in the courts. What happens later, I think it's something else, but I think it should be viewed that people are having confidence in the courts to challenge certain rulings. But I'm going to open the floor for questions. Yes?
This question is based on actually my job as managing 20 odd different countries across Africa and the trading relationship we have with the UK. And there's one risk that we haven't actually spoken about here that actually stops most of the clients I work with even getting into the other risks, particularly in countries like Zimbabwe, and that's opportunity risk. And that's for a given amount of time and money, could they not actually make more money somewhere else? And in most cases, they don't even bother, back of the fag packet, they don't even do that calculation. They just do Mauritius instead. So maybe you could help me do my job by helping me answer that question of why bother?
Yeah, good question.
I think a lot of it has to do with the actual investment you're looking at. There's some areas where Zimbabwe is just a logical place. So platinum, for example. I mean, outside of South Africa, it's Zimbabwe. Diamonds is a murky place now, but the resource is there, right? So when you look at certain resources, that just is what it is. I made a point earlier about volume, right? In certain sectors like retail and going past retail, private equity, et cetera, they're looking for numbers. And when you look at that opportunity cost is real because we can't compete with numbers in West Africa, for example. So again, there has to be a volume aspect when you're looking at those kind of industries, which means that you have to look at Zimbabwe, but also the neighboring countries to aggregate. So I wouldn't say that you should be targeting Zimbabwe alone, but as a part of a bigger region with all the relevant transport links and everything that's being done. I mean, there are lots of initiatives that are being done to actually liberalize trade within the SADC region, for example. So if you start marketing it as a region, you might actually get more traction with people thinking about the opportunity cost issue. Or, failing all else, you point them at something that's only in Zimbabwe, which is where they'll have to deal with us eventually.
Yeah. Isn't his question akin to asking why invest in distressed debt versus investing in A-grade bond? Someone would say returns, risk-adjusted returns.
But that's
Yeah.
the thing. I'm not convinced that
Yeah.
some of these investments are distressed. And again, it's a perception thing.
Yeah.
So I had this conversation with someone the other day. I said, there's a Pan-African conglomerate. We're actually a part of it called Liquid Telecom. Very, very good. They heard Pan-African. And immediately they thought, okay, interest rate, I'll price it at 15 to 20%. And I said, this is Liquid Telecom. And you see, what Africans would perceive as AAA, the world does not perceive as AAA, right? And even though they are actually a AAA rated entity. And this is where the credit risk is such an important part of this business because immediately you're looking at debt funds, which is all the rage now in London and abroad. Debt funds are the new thing. Yeah. And when they're looking at who to lend to, they look at African risk, and you will not find single-digit returns, interest rates. It's just impossible to find, no matter how clean the credit is. Yeah. And that's something that we have to adjust to, right? Yeah. To actually find out how we can get the cost of capital down. It'll hurt them a little bit because a lot of them making those investments and finding out that there was no risk at all. So they're just getting a free 15%. Yeah. Right? Wow. So it's all perception. Yeah.
Okay. Any more questions?
Maybe just to add some more light on the question of why bother. I think it's a lot more than just the numbers. The question why bother, should be looked at deeper than just the immediate return. Zimbabwe has a very educated population. I said agriculture is probably one of the hottest sectors to invest in right now. But I think our biggest asset is not really the resources, although we have many resources in Zimbabwe. I think it's our people. People are highly educated, highly trained, highly literate. You know, it's a common fact that we have, if not the most educated population in Africa, certainly in the top 3.
But Ken, how do I reconcile that with what Tawia was saying, that they have had to outsource management teams for agriculture projects, and yet we are viewed as a very educated people? Is it education versus experience?
Maybe it's the
Competence?
skill, maybe
Yeah.
it's the skill set that needs to be transferred. But I think once that skill is localized, Zimbabweans are very constructive and productive people.
Yeah.
And the why bother question is really, you're investing in the people.
Okay.
In anything, you know, whether it's a business you're buying into, it's always about the people. And as a country, my view is, you know, why bother would be a good reason for the people.
Yeah.
Because you're investing into a future generation that's going to look after your asset, and it's going to sweat well, and it's going to be managed well. Whereas if you go into a country that's poorly educated, or doesn't have the same type of quality of people, the immediate return may be better, but over a long term, I think Zimbabwe will fare better. I hope that's a reason.
Okay. Any other questions? Okay. I think it's 10 minutes to. We are right on time. Any last words just from you, lightning round, before we round up this panel?
So I just want to share a short anecdote. Everything that we've heard today, and I think, Ken, you just highlighted a key principle for me. As a key individual in our organisation sitting in South Africa, a lot of the things that we've talked about from a country perspective are actually things that we faced as facing as an organisation. So I am sitting in a 55,000 people organisation in the head office, and I'm trying to share the story with my organisation that I work for on why invest in Africa.
Because I actually suspect your parents are from Zimbabwe with the kind of passion.
No, they don't actually. I've just got a lot of friends. The key for me is it's people. It's the fact that we're prepared to sweat. And it's talent. We're investing in talent. And the diaspora, I am living proof of that. I lived overseas for 10 years, and it took me 10 years to go back home. And it's been the best decision I've made. And I love what I do, and I love being able to, and I shared, and I started this morning with this. It's up to all of us in this room to leave this room and actually dispel the perception that this is where investments should be being made, and that they're actually investing in us as individuals. And I made a little small note to myself, and I do this when I actually do recruitment, is I often ask our receptionist what she thinks of the candidate when they walk in, and I have a little score that I put on my sheet. And my little asterisk was, when were you last in Zimbabwe? Because actually I think that tells you how serious you are and how much you actually know about what's going on the ground. And that's how I learn. I'm not learning from a textbook. I'm not learning from my Google searches and reading Thomson Reuters News. I'm learning from being on the ground.
Yeah, I'm going to use the example of tobacco, which was cited earlier. You know, Zimbabwe and Africa generally is really at the primary stage of development. At this stage, we're taking stuff out of the ground, or we're growing stuff. And it's so, the income that you see and the size of the GDP is all basic. We have the opportunity now to put in structures and governance in place that will allow us to move to the next phase, which is actually starting to use finance, starting to use derivatives. We know we've got constant flows of tobacco every year. We should be having forwards, swaps, options, and that kind of stuff, which will develop our economy in a way that, frankly, nobody even understands yet. We are now simply providing primary inputs for the rest of the planet, and that has to change. And it's all about the structures and the governance structures. Once that moves forward, I mean, tobacco, which now we're touting as one of the biggest indicators of how well our economy is doing after the controversial land reform. But that in itself has so much more upside. And it's the same with every single other commodity we've got in the country.
Sure.
Tremendous potential. And because of our human intellectual capital, we're probably best placed in the whole continent to actually take advantage of that.
True, true. Strong words.
I'll finish with where we started. What are we pricing? How do we put a price tag on a future generation? Our generation of Africans is the youngest on any continent in the world. We have 120 million middle-income households in the next 3 years turning into 200 million. There's a huge consumptive market out there, and Zimbabwe plays a role in that. Finally, I'll leave with the words of a famous Jewish philosopher who said, if not me, then who? And if not now, then when?
Yeah.
Thank you.
Very strong.
Why Zimbabwe? What I would say is, yes, we do have some room to get our market sophisticated enough so that institutions that have like 64-line spreadsheets can plug in data and be able to say, okay, I'm comparing this with this, if I can go to Zimbabwe. Yes, we do still need to get to that point. But in the meantime, as well, also let's not shun away because of that, because there are some investors there that will go in a position like ours, and then not tell everybody about the rest of the thing because they want to keep it to themselves. So there's been a lot of that too. So again, what I would love, if I could leave you with one more example, they say a story is told of two guys that came to Harare. They got to the airport then. They were glad to be in Zimbabwe. As soon as they walked out of the airport's gate, they noticed this guy, he was walking barefooted. One guy jumped out and said, these guys have no shoes, I'm going back home.
Yeah.
The other one guy said, my goodness, they have no shoes, what a market.
Yeah.
So it depends on the approach, what you want. Either you're looking at it as a market, as an opportunity, there's a lot of it, or you can scare the fearful away. But again, I always say Zimbabwe is like Kenneth said, it's the best way to invest on a generation because you have a whole middle class that's upcoming.
Yep.
Imagine the potential in that. In what other environment can you get the level of returns that you're getting in Zimbabwe? Even if you go to guys on Wall Street that are written about, you find out their track record is about 8%. You go to Zimbabwe, you have a micro-scale guy who's doing 20% and no story is written about him. So there is that opportunity.
Yeah.